Hello everybody, welcome back to another YouTube video. And on this YouTube video, we're talking about a very important topic that sort of corresponds with what we did initially on our two previous videos. So let me do a recap for those that already missed it. For our first video, we talked about market structure. Then we talked about the buy sides of market structure. Then the second video, we talked about the sell side, where you can sort of get entries or possible trades using the strategy to sort of look for where you can buy the market and then sell the market. Now, one of the challenges that people go through is actually getting where to buy exactly, or the things to look out for when you plan on buying and the things to look out for when you plan on selling. So now on this video, we will be talking about something called liquidity. And what is liquidity actually? So liquidity basically is areas in the market where market will definitely push price to. And I'm going to be explaining that to you guys. So which means liquidity area serves as zones where market will come into and the market will sort of react around that area. So you want to make sure that your buys or your sales based off of market structure is in correspondence with your liquidity area. You want to make sure that you are not having a higher low at the liquidity area. Market will not basically respect it. Market will basically come there and take it out. Or you're expecting a sell at a lower high where it has liquidity. The liquidity will be taken out before you now have your sales. So I'm going to be talking to you guys on this video on the things that you should look out for, on how you sort of will be able to get proper buy trades or proper sell trades using liquidity in correlation with market structure, all right? Because everything is all interwoven. You need them together, right? So pay attention as we jump on this video together. So on this video, so for liquidity, we have something like this market creating a low, then a high, all right? In between that, market will create something, market will push down price, right? Market pushes down price into the low area, right? Market push up price. Then you can have something like this, market push down, right? Upon pushing down, it created a higher low, then pushes up price again. Now it will now come down to create an equal higher low area, right? The market now pushes up price again to break structure. I need you guys to understand something. Automatically, these two areas that are actually sitting down here is already a liquidity zone, because it's actually serving as an equal low, which is basically an equal lower and equal higher low area, right? So automatically, this is a liquidity area sitting down here, despite the fact that both of them broke structure, which means this broke structure, this actually broke structure. So automatically, market is supposed to return back price into this area and actually buy based on what most people already know. But this is already having a negative effect. Why? Because this area that you're actually seeing here now has a liquidity. So because it has a liquidity there, even if it has a higher low there, but because there's a liquidity there, market will definitely sweep off that liquidity area. And what will it do next? It will sweep off the liquidity area, come down to this one that is the non-liquidity zone, close to the low that is sitting down here, and sort of push up price from there. And that's why you now have market pushing up price from that area. Then what would then happen? That will basically be our region that we'll be looking at for the possible buys, right? Below the liquidity area that is sitting down there. Now, where would your stop loss will be retained at this low that is here. This is where your SL will be, all right? So we're looking at that particular area being the SL. Now, why? Because you cannot basically set your stop loss in between this, because like I said before in the market structure video, this is the beginning of the particular trend. So automatically your stop losses must be here while you're expecting your entries to be at this higher low that basically is the continuation pattern of the trend below the two higher low areas representing a liquidity zone. Now let's now look at the chart representation of what I'm talking about so you guys can understand this properly. So come with me as we look at the chart representation here. Now on this particular chart here, you guys will see that market created a low here, right? It created a low here. Then, market then, pushed up price to create a retest that is here. Then now let's look at this properly. Market pushed up price here. Then it retested. Sorry, let me do this again. Let me do that part again. So, market created a low here, as you guys can see this, right? Automatically after creating a low here, it pushed up price to create this pullback. Then it pushed up price here again, getting to this high, right? But don't forget that upon getting to this high, we have liquidity area sitting down here already, which means this is our first liquidity, which is here, which is basically this equal areas that are here, would be the first liquidity zone. Right? Then the second liquidity zone is the one that is already marked here. Can you guys see what I'm talking about? So this is the first liquidity zone, this is the second liquidity. Despite the fact that all of these areas actually broke structure, and bear in mind, this is a 2-hour time frame. So all of these areas already broke structure. Where you're expecting market to return back into these areas and actually buy. But it will return back there and buy, but the buys are actually fake outs. Right? Look at what happened here. Market created a liquidity zone here, which is basically these two equal lows. It first swept off these two areas by pushing down price into this zone. Right? So upon getting back here, it started buying, only for it to come down, kill all of these areas, and tap back price into this area that is basically the discounted zone, which is showing that this area is the one that has the higher low that sort of doesn't have liquidity there, right? And then what did we see for the after clearing these two liquidity areas? Market pushed down price into this area and then bought. Now look at the stop loss. The stop loss was not here. This is what I'm talking about. The stop loss was not here. The stop loss came down into this area, right? So that you don't have a case scenario where market sort of like sweeps off liquidity and then you don't basically get your proper buys. So market pushed down price into this particular area, and then what did we do? We had an instantaneous buy to the upside. Now, if you look at this closely, this is a trade of 47 pips stop loss to basically get 112 pips take profit. So this is the pattern that you can use to avoid getting stop hunted most times, showing you the quality places to look out for, the discounted places to look out for when you plan on buying using market structure. Then you must correspond your buys with liquidity, so that way you avoid at least being stop hunted most times. So this is a chart representation for the buys. This is the chart representation for the buy structure using liquidities. All right, so see you guys.